Hello and welcome to the lecture for the second part of Chapter 6. In this section, I'll talk about receivable turnover, and I'll talk about reporting, controlling, and safeguarding cash, those two topics. So before we get into those topics, I'm going to talk a little bit about managing receivables. So having a receivable go bad is very consequential from a profit standpoint. If you have a company that is selling products at $1,000 a piece and you have a 10% profit margin, if one sale goes bad and that person doesn't pay you their $1,000, you need to sell 10 more products to make up the net income to cover that $1,000 loss. So it's very consequential. So it's good to monitor receivables. It's good to make sure you call people immediately when it's past due. So contacting customers on the 31st day and not asking if you plan to make payment, but asking for the check number for the payment. If the customer doesn't respond to inquiries, you might have a problem. You may need to involve a collection agency or some other third party to help you collect that. If a customer files for bankruptcy, that is a legal protection. You have to stop pursuing collection at that point and hope that through the bankruptcy process that you get some kind of settlement. If the customer closes their business, it may be very difficult to pursue collecting that debt, because if the customer was a corporation, well, the owner of that corporation doesn't have to pay. And then if you can't locate the customer, which happened to me one time, that can be problematic as well. So in terms of reporting accounts receivables, we'll show different kinds of receivables. Here we have other receivables and we have trade accounts receivable. Maybe under long-term financial assets, we might have had notes receivable. In this case, note that we're showing it less the allowance of a doubtful account. So we're showing the net amount. Oftentimes you'll hear that referred to as net realizable value, how much we really think we're going to collect. Receivables turnover ratio is a very important figure because it can tell you if you're indeed being paid according to the credit terms that you're offering. So the way to calculate that, and I think that the second version here is a little bit better. So the way to calculate that is to divide net sales by the average accounts receivable. Now, in some companies that are not cyclical, you can take beginning plus ending receivable, divide by 2. If your company is cyclical, you'll want to add all 12 months, divide by 12 to get a better average. So that will tell you how many times you're turning over receivables. In this case, it's 9.1. There's not a lot that you can intuit from that number. What I like better is using that to then calculate the average collection period. So I know I have 9.1 turns. I can divide the number of days in a year, 365, by 9.1. That'll tell me my average receivable is 41.1 days. So I know if I'm offering my customers net 30 terms, they're not paying me on time, and I can do some things to improve that. Improve my collection efforts, be more careful in who I grant credit to. There could be a variety of policies that I can put in place to make that better, and then I can track that number and see if it improves. So that's why I think this is a really valuable ratio. So next topic, cash and cash equivalents. So cash is anything a bank will accept for immediate credit to an account. So it could be checks that you have in your hand, cashier's checks, bank notes, things like that that you can immediately put into a cash account and spend. Cash equivalents are things that are close to cash. They could be converted into cash easily without suffering any significant loss. So that might be certificates of deposit. Those kinds of things are considered cash equivalents. So some internal controls for cash. I could teach a whole class on this topic. This is a really important subject. First and foremost, separation of duties. Anybody that is in the chain of purchasing or securing services for the company in return for payment, every step in that process should be a different person. Anybody involved in receiving cash from customers or from whatever the source is, every step in the process should be a separate person. Again, the purpose for that is it's a lot harder to get away with something if it involves multiple people. So second, it's important that deposits are made daily and intact. That means all the money that comes in every day goes to the bank by the end of the day, period, no exceptions. Make sure that there is separate approval for purchases and for disbursements. So one person approving that something is purchased, a different person approving the payment of that bill. And then make sure that there is monthly reconciliation of every single cash account. So you'll find things that are inappropriate or things that shouldn't have happened when you do that. And again, that should be done by somebody that isn't involved in receiving cash or dispersing cash. So a bank reconciliation starts with the bank statement, and you probably have been through this a bit, so this may in your survey course, so this may be a refresher. But here's a bank statement from Valley National Bank of Los Angeles. Every bank will look different, but you can see the same common elements. Up in the upper right-hand corner, we have the account number. That's important because we may have multiple accounts with this bank. The period of time in question, this is the month of July, and then a recap of what the beginning balance was, what money went in, what money came out, what the ending balance was. The figure that's important there is the ending balance. And then we've got all of the activity, checks that cleared the bank, deposits that were made into the account, and then kind of some unusual types of activity. ACH is basically a wire transfer. Somebody wired money into your account. NSF means a customer paid you and they didn't have money to clear that check, so it bounced and the bank took it back out of your account. Those are a few of the things, but there's a legend at the bottom there. So the problem is the recap of the bank statement says we have at the end of the month $3,359.78. We look at our internal records, so our check register, to see what is our ending balance, and we show $2549.99. So the question is, which number's correct? Which number should I put on the financial statements? Well, the answer is usually neither number is correct. There's something in between. So a bank reconciliation is done in two parts. The bank section, which is usually on the top, the bank section, starts with the ending balance that the bank shows. And then we're going to adjust that for anything that we know about that the bank does not know about. And when I say the bank does not know about, I mean it's not included in the statement they just provided to us. So if we took deposits in after hours on the last day of the month, the bank doesn't know about those deposits. They're not reflected in the balance the bank is reporting, but we, the company, know that we made that deposit on the last day of the month. So we're going to add those deposits to the ending bank balance, because if they had known about them, if they had stayed open later, they would have included it in our balance. So we add it to it. And then I'm going to subtract all of the checks that I've written that have not cleared my bank yet. So I'm going to have to do a comparison of what does the bank show has been cleared, meaning the other bank that our customer presented the check to, or our supplier, that has cleared our account. So we're going to check that against the checks we've written. And we're usually going to find that checks we wrote fairly recently have not yet cleared our bank. And those are considered outstanding checks. We know about them because we wrote the check. The bank doesn't know about them because they haven't been presented for payment against our account yet. So I'm going to subtract those outstanding checks. Then if I see that the bank made a mistake, I'll also adjust for that. It doesn't happen very often, but it could happen. The next section is the company section. So this is going to start with the ending balance per the company's check register. So what did we think we had in the bank at the end of the month? We're going to adjust that for things the bank knew about that we did not. So if we learn on the bank statement, for instance, that a customer paid our bank directly and the bank put it in our account and we didn't know about it until we saw the bank statement, we're going to add that to our balance, because if we had known about it, we would have included it. We're going to subtract anything where the bank took money out of our account and we didn't know about it. That might be an NSF check that a bank charged back to our account. It might be service charges that the bank charges all their customers. Could be check printing fees, could be interest, things like that. We'll record all of those as deductions. And then hopefully when we put all of that together, both sides will be the same. The adjusted balance for the bank, which you can see here is $2630.99, is going to equal the adjusted balance on the company's records. So same number. But we're not done. So the adjustments that are in the company section now need to be recorded in our accounting system and posted to our general ledger, so that our ending cash balance on the trial balance, and consequently on our balance sheet, In this case will be $26.30.99. So I need to make an entry for the note and the interest that was collected, the bank service charge, and the error on check number 879, which means I'll have to go find check 879 and figure out what that check was for in order to know how to make the adjustment. So in this case, I'm going to debit cash, credit note receivable, and interest receivable. I'm going to debit accounts receivable and credit cash to reverse the deposit I recorded for the customer that gave me an NSF check. I'm going to record bank fees as an expense and credit cash. And then the error on that check number was due to accounts payable, so I debit accounts payable and credit cash. So then I post these to the general ledger, and then again, last double check, confirm that my balance is the same as the adjusted balance. So that is the end of the lecture for Chapter 6. Thank you very much, and I will talk to you in the next chapter.